Hello everyone, welcome back to the channel. Today we will talk about something very important in internal auditing and risk management. How to create a risk universe. Now, many people hear this term and think it sounds very technical and complicated. But honestly, the idea is very simple. A risk universe is basically a complete list of all major risks that can affect an organization. That's it. It is like creating a risk map of the company. Because before internal auditors decide what to audit, where to focus, or which areas are high risk, first they need to understand what can go wrong in this organization. And that process starts with the risk universe. In today's video, I will try to explain what a risk universe is, why it matters, and how internal auditors create it step by step. So let's begin. What is a risk universe? A risk universe is a structured inventory of risks. You heard me. Inventory of risks. It includes operational risks, financial risks, IT risks, compliance risks, fraud risks, strategic risks, and many other risks. Think about it like this. Imagine you are a doctor. Before treatment, you first need to understand the patient's full condition. Internal audits work the same way. Before creating an audit plan, you first need to understand the organization's full risk landscape. That is the purpose of the risk universe. Without it, audit becomes random, and many important risks may be missed. Why is risk universe important? This is very important because internal audit resources are limited. You cannot audit everything. You have limited time, budget, and people. So you must prioritize. And risk universe creation helps you answer these questions, like which processes are most critical, which areas have the highest exposure, where can the company lose money, where can fraud happen, which systems can stop operations, which controls are weak. This is why strong risk universe creation is the foundation of risk-based auditing, audit planning, and effective internal audit. If the risk universe is weak, the audit plan will also be weak. Now, let's start with step 1. Understand the organization. The first step is very simple. You should understand the business. You cannot identify risks if you don't understand operations. This is one of the biggest mistakes young auditors make. Sometimes auditors directly jump into checklists and templates. But first, you must understand how the company makes money, how operations work, what management worries about, and what can damage the organization. So, what should you review? You should look at organizational charts first, then process flows, after that financial statements, then strategic plans, KPIs, policies, previous audit reports, and management reports. Those are the things you should look at. Also, you should talk to the people. Very important, because risks are not always visible in documents. Interview department managers, finance teams, IT teams, HR, operations, procurement, sales, and compliance teams, and many others, whatever you think of. Ask simple questions. What are your biggest challenges? It's an important question. What keeps you awake at night? What can seriously damage operations? Where do mistakes happen most? Which processes are manual? Which areas depend too much on people? These discussions are extremely valuable. Now let's come to step 2, identifying audit areas. After you understand the organization, next step is identifying auditable entities. This means the areas that can be audited. For example, procurement, sales, treasury, retail stores, if you are in retail business, manufacturing, inventory management, payroll, IT infrastructure, cybersecurity, third-party management, e-commerce, marketing, supply chain, HR processes. It goes like this. Each company will have different areas, of course. A manufacturing company and a bank will not have the same universe, same risk universe. So, risk universe must always be customized, not copied from the internet, or that is not copied from another company. This is very important. Now, if we come to step 3, identifying risk inside each area. Now we go deeper. For every audit area, you identify possible risks. For example, procurement risks, fake suppliers, conflict of interest, overpricing, unauthorized purchases, duplicate payments. Those are procurement risks. Inventory risks, theft, stock losses, damaged goods, incorrect counting, obsolete inventory, all related to inventory and warehouse. IT risks, cyber attacks, weak passwords, system downtime, unauthorized access, poor backup processes. Let's come to HR. Ghost employees, payroll errors, weak segregation of duties, compliance violations. This stage requires critical thinking. And remember, risks are not only financial. Some risks damage reputation, customer trust, operations, legal compliance, or business continuity. Okay, let's go to step 4 now. Categorize the risks. Now you organize the risks into categories. This helps management understand the overall picture. Common categories are strategic risks, operational risks, financial risks, compliance risks, IT risks, fraud risks, health and safety risks, reputational risks. These are the main categories. For example, a cyber attack may be an IT risk, also an operational risk, and a reputational risk at the same time. Categorization creates structure, and it makes reporting easier. Now let's come to step 5. Assess risk levels. Now comes the scoring stage. Not every risk is equal. Some risks are small. Some risks can destroy a company. So internal auditors usually evaluate impact and likelihood. Impact means how serious is the damage if it happens. Likelihood means how likely is this going to happen. For example, small office supply theft may have low impact, but ransomware attack may have catastrophic impact. Some organizations also evaluate control effectiveness, regulatory exposure, fraud sensitivity, or management concern. Usually, auditors use low, medium, and high, or numerical scoring models. This helps prioritize audit activities. Now, if we come to step 6, at this level, we have to create the risk universe document. Now, everything is documented. Usually, the risk universe includes process name, risk description, risk owner, risk category, inherent risk level, existing controls, residual risk level, and possible audit coverage. Some companies use Excel, some use audit software. The format is not the most important thing. The important thing is clarity and completeness. The document should help management clearly see where the major risks are. Now, if we come to step 7, continuously update the risk universe. This is another important point. Risk universe creation is not a one-time exercise. Risks constantly change. New technologies appear. New regulations appear. New fraud methods appear. Business models change. Economic conditions change. So the risk universe must be updated regularly. For example, AI risks, cybersecurity risks, third-party dependency, cloud systems, geopolitical risks, supply chain disruptions. These risks are much more important today than they were years ago. A static risk universe becomes outdated very quickly. Let's also discuss common mistakes, because many organizations make these errors. Mistake number 1. Copy past risk universe. Some companies simply copy risk lists from another company. That doesn't work. Every company has different operations, different culture, different systems, or risk exposure. Mistake number 2. Focusing only on financial risks. Modern internal audit is much broader. Today, cybersecurity, culture, third parties' reputation, and operational resilience are extremely important. Mistake number 3. Not involving management. If management is not involved, the risk universe becomes theoretical. You need practical operational insight, so include the management, the managers, the chiefs of departments, the directors, include everybody to your risk universe. Mistake number 4. Never updating the risk universe. An outdated risk universe creates outdated audit plans. So now let's summarize what we talked about. Risk universe creation is the process of identifying and organizing all major risks inside an organization. That's the line. It is the foundation of risk-based internal auditing, also audit planning and strategic audit focus. The basic steps are: understand the business, identify audit areas, identify risks, categorize risks, assess risk levels, document the results, and continuously update the universe. Remember this: good internal audit does not start with testing. It starts with understanding the risk. Because if you identify wrong risks, even a perfectly executed audit can be irrelevant. Thank you very much for watching. If you enjoyed this video, please like and subscribe. And tell me what you think in the comments. See you in the next video. Thank you.